binomial option pricing model, and this is intraday option trading tool. Once you are going for index future, we have to select and we have to go for the Nifty 25th July, and we have to load the data so that option strikes and everything will be get loaded. So once the data is getting loaded, you will get the strikes, everything here. So I want the strikes near to my thing, but before that I need to analyze the future. Future analysis says if the Nifty goes above 5908, it will be an uptrend. 5871 below, it is downtrend. And expected price movement is 73 points. Volatility intact is 25%. So all these informations you are getting. And now Nifty is around 5898 level. Nothing wrong. Nothing wrong. We are couple of points away from the uptrend. So you can say, so 10 points we are away from the uptrend. However, 20 points we are above from the downtrend. We are 20 points plus from the downtrend price point. We are 10 points below from the uptrend. So let me go to the nearest strike. 5900 will be the nearest strike. I will be just hitting the number 5 in my keyboard so that it will take me to the all 5900 strike and analyze the option. So this is telling me buy the options, the time we have discussed, that time itself it has got changed to a little bit also. So it is saying that buy the options at 104, it is now 196, so 2 to 3 rupees, don't worry about that. So it is saying that buy the call option at 103.6 for with a stop loss of 83 for targets till 150 if the Nifty touches 5983 level. So nothing wrong if I am buying this call options. Nothing wrong if I am buying this call option. Same time, let us discuss something on the put option also. So put option 5900. So let us see what price it is quoting now. Nifty 5900 put option. It is 98 now. So we'll just refresh this thing so that load data. So we'll be getting a fresh data here. So since I am discussing and doing this thing, so all are getting the audio. At 89 for a target of 58. So this is what we have got. So now you are close to the buyer side because 5908 is your uptrend signal. You are close near to that. So this experiment also, let me save it. So let me save this experiment so that this also will refer in future. Can anyone will give me a very fantastic trading strategy I can develop? So assume we have drawn the 5900 call option. 5900 call option. Say because now the values have changed. So this is based on that our buy trend and sell trend everything will change. Assume I am buying this call option. Current price itself at 97 and keeping the stop loss at 87 or even though 82. Say 82. One faster target also I am keeping. So 5 point, let me take some additional risk. With a stop loss this thing. If I lose in this trade, how many points I lose? 5? 1. 15 points I can lose if it is going against me. So once it goes against me, I am going to lose this one. So let me see for the put option. So with this respect to this value, and if I am winning from this side 97 to 108 means 11 point I am going to win here also. Just if my trend gives a signal here, then I am going to till 108 I am just going to win 11 point. If from here it slips, then I am going to lose 15 point. Nothing wrong if I buy a call option at 97 and considering this put option also I am going to buy at 97. This is simplest strategy. This is not a very technical strategy where Greeks are analyzed and all these things are analyzed. Simplest strategy. So the moment this will go to 108, my put option can go to 89. Can go to 89. Subsequently, it can fall to 84. Subsequently, it can fall to 58. So suppose I am getting 58 or 59 to the optimum range. So I am not going to wait till that range. So if I am just winning this straight, so you can say here 89 to 97, some 7 to 8 point I can lose in the first target itself, and this is the entry price. 11 point I can win. So 11 point and 8 points, you can say 3 points is the net gain I am setting for here. And preferably if the trend goes upwards and towards me, then I can get good profit out of this trade. However, sometime also if my 15 point losses comes here, some amount of losses I can recover here, 8 point losses I can recover if the trend backtracks from this point and come down to 5871. So nothing wrong if someone is thinking of buying a call option and put option together, but time value decay factor is a must. Time value decay factor is a must, and time value decay factor is a must, and time value will affect your trades if it is a range boundness occurs. But you are going to take for the intraday trade, so nothing wrong about that. So we are also going to save this experiment for the put option. So put option, this experiment also we have saved it. So if you are thinking to take a strategy also, you can think of initiating a strategy. Nothing wrong in that. So nothing wrong in that. If you are thinking to initiate a strategy, you can initiate also with call option and put option. So Nifty has backtracked and come down to 5881 level. So in between this put options and other things also changed. So call option, put option both have changed also. So fine. So this is the option intraday trade. So what we have done here, I'll just summarize what are the actions we have taken. First, we have analyzed the future by hitting on this button, and based on the future analysis, we have found out two price points wherein we can say that above this price point trend will be up, below this price point trend will be down. And whenever this uptrend is giving you breakout, that time we are thinking to buy a call option, because selling of a unit requires some margin and other things. Whenever we are thinking that trend will be breaking in the downside direction, that time we will think of buying the, that time we can think of buying the put option. And put option, we can think of buying the put option. So you can think of August series, September series, whatever series you want, you can think of. There is no restrictions in that. So you can think of selling the options also. And this also gives you an opportunity to do the arbitrage trade in the options. So it gives, once you are analyzing for 5,900 put, for 4 different strike put option, what is their fair value? So based on this fair value, you have to compare with the current market price value. Any option which is trading above its fair value will be overpriced. Any option, means any of these strikes are trading below its fair value, is underpriced. So your aim will be to buy the underpriced and sell the overpriced. So this is what, by this process also you can think of doing the option arbitrage. So this is what option intraday. So let us go for a stock option also. Stock option also. So let me take the State Bank of India. It is, so 25th July. I'll be loading the data here. Once the data will be loaded, that time I will get all strikes and all their premiums in my thing. So after this data will be loaded, then only I can able to, yes, all strikes are loaded. Let us analyze the future. Future is telling that above 1924 my trend is up, and 1902 my trend will be down. My trend will be down 1902, And what is the price? 1914 it is now. 1914 is now. So this is the State Bank of India future or equity, let me check. So this is for equity. So let me go to the future segment. So let me go to the future segment. State Bank of India, yes, 1923 now. So 1923 it is the price now. 1923, close, very close, near to the buy entry price of your things. So quickly we will do the call option analysis. So 2000 call option will be nearest. 1950 also nearest. 1950, 50 rupees, and analyze the future we have done. Analyze the option. So 54 rupees you can buy. Keep a stop loss of 44, and this will be your targets. Quickly you can think of purchasing this thing also. So sometimes because of the implied volatility factors, it may not inline with this thing, may not inline with these things. Whenever you are trading in the option, stick to the option entry prices. Whenever option comes to its entry prices, you think of initiating the trade. So 54 it is telling you, 52, 45 it is quoting now. Think this is a call option, we are close near to the buy entry. Keep a stop loss of 44 and initiate this trade. So this also this experiment also I am saving it here. So this option also I am saving. This experiment also I am saving here, and so this analysis also I am saving here. So here call option we have done, and we are close near to this value, and we are expecting the once the breakout happens 30, so 57 rupees it can give, and 35 level it can give me 60 rupees. So till 79 I can expect, with the expectation that it should go to 1969. So here one factor you have to very closely watch out. Implied volatility is 33% and underlying asset volatility is 42%, near about 41.56. So at any point of time, if you are finding out this is a 30% difference, more than 30% difference, means 33 into 30 divided by 100. This is the 33% of 33 added with 33. So it can say near about 9.9. So 9.9 if I can add it here, I am getting here 9. 9 3s are 12. So 12 and 40, 42.9. So I am within the range. If implied volatility and volatility differs more than 30% from their calculated values, then you should not trade in the options. Then you should not trade in that particular option. So if this underlying volatility could have been above 42.9, I must have avoided this buying in the options, buying trade in the options, because that will invite the decay, volatility decay parameters in the options. But in my case, this is not the fact. So I am well within that limit. So I can think of purchasing this call option, having a stop loss 44 and expecting a maximum target of 79.7, in between targets of 57, 60, 63 and 72. So these are the things I can also think of doing. So now I will be moving trade. If you are aiming to get good money from the market, if your ambition is to get good and rational money means you must not aim that every year I should earn 1000% return from the market. This is impossible. Those who are committing on telling you, they are just fooling you, and that is not, there is no such method is available. If that same man can earn 1000% per annum, then he won't teach you that method, or he won't give you that method at all. So here pair trade has the capacity to give you an annual return varies from 40% to, I can in more conservative way, I can say it will be varies from 20% to 60% range. 20% to 60% range it can give you, and it has the power to protect your capital to the tune of 90% above. Greater than 90% you can protect your capital. So I'll demonstrate a couple of things here. Then we will be moving to the, so I have just taken the stock future. I am just taking the Axis Bank, or I will be taking State Bank of India, ICICI Bank and HDFC Bank. So 25th July, and lot of literatures I have given in the website for the pair trade. So let this data to be loaded. Once this data will be loaded, the flag will be saying that data load is completed. So once that flag comes, then we will be just hitting this button and it will give us all analysis together. So it has that power also. So let me load this data. Once this data loads, then we can, because we are in the live streams, so live streams, let me close this screen so that the data loading will happen somewhat quicker. To apply the pair trading technique, you must learn that technique. Without learning, just getting some resistance support, you can't able to trade in this. You have to learn that method properly. You have to learn each and every parameter associated with this pair trading. You need to understand what is the importance of volatility, what is the importance of beta alpha correlations, and all these things is very, very important if you want to be a pair trader. So pair trading recommends buying State Bank of India and selling HDFC Bank currently, and buying State Bank of India and selling HDFC Bank currently. Correlation is 0.5876. So 0.5876. So this is close near to my comfort level of 0.6018. So if you think you can initiate this trade also. This also recommends buying State Bank of India and selling ICICI Bank. Correlation is 0.57. It's also close near to this. For intraday basis, it is telling me to buying State Bank of India and selling ICICI Bank for intraday basis. In fact, I will take one lot from each. See, if I am taking one lot from each, so this experiment also I am going to record it and I am going to save it. For the intraday, we got, this is the recommendations, and day end we will follow what has given us in this. So this is what we have analyzed. So let us move to the market watch screen and see what are the prices it is trading, and one lot each we are going to take. So it is telling buying State Bank of India 1923 and 1069. So this also I am mentioning here. So this is also I am going to mention here that one lot we are going to take. So SBI 1923 and ICICI 1069. If you want also, you can think of a hedging also here. So if you want, there is, and HDFC Bank also, let me put the HDFC Bank future here. So HDFC Bank, so 663. So this is the thing we are getting for the SBI and ICICI Bank, and we are also buying SBI and selling HDFC also it is giving us. So let us move and put that value also. So HDFC at 663, this is for intraday. intraday analysis. Intraday analysis gives you this kind of things, and this purely you have to exit in the intraday basis. You cannot carry this position for next day because you have done the analysis based on the intraday analysis. So how to find a pair? How means so this has taken the past. For the beta analysis we are taking past 90 days data for analysis because this is based on purely on the beta decoupling. So purely on the beta decoupling, so past 90 days analysis is being done here and correlation is done. Suppose you are going for a positional analysis, you will be getting a different view. Just see what this positional analysis gives. So positional analysis, whenever we are moving, maximum I can hold. Positional means maximum, this is for intraday, and whenever I am doing for the positional, maximum I can hold the position till 10 days. Maximum 10 days, not more than 10 days. Maximum 10 days will be having my position. Max 10 days. Max 10 days. And what is the view I am getting? So here I am analyzing Johnson's alpha, Sharpe ratio, Trainer ratio and beta decoupling. All four I am analyzing. And here I am getting correlation parameter into confidence also. This says, suppose HDFC Bank and ICICI Bank, these three parameters says buying ICICI Bank and selling HDFC is recommended, and that too correlation says that trade without option hedging. Beta decoupling says that no, you do not trade in this. However, 3/4 of the view out of 4 analysis, 1, 2, 3, 4 till beta. So correlation alone will give you that whether to hedge that position or not. 3/4 analysis goes in the view of the buying ICICI Bank and selling HDFC. One view is against me, and it is to trade without option hedging. And here too, all views, SDFC and SBI, all views are saying that buying SBI and selling HDFC. However, the correlation parameter, so correlation parameter for HDFC and ICICI, HDFC and SBI, it is saying that we are in a 0.58, so it is not a comfort zone. So do not initiate the trade. So here there is no view, neutralness, because you are close near to this. So but still it says that you do not initiate this trade now. So nothing, no informations are there. So correlation gives no information, means do not trade in that, wait for some more time. And ICICI Bank and SBI, so here there is no views because we are in a very fragile condition now. So better correlation without option hedging it is giving, or with option hedging it is giving. You can initiate that trade. We will fix this also in that programming. So it should come with a, means you should not trade in this condition. ICICI and SBI also same thing, but views are divided. So this is, we are not going to initiate any positional trade in that. So I am going to take one more pair in the same banking sector. So preferably I will be taking IndusInd Bank, and I will be taking Syndicate Bank, and I will be also taking the Dena Bank. Same 25th July. So now I will be just waiting on this data load. Data is loading. So once this data load will be completed, then I will get some view that whether to. But for intraday, I have already got that I am going to buy State Bank of India and sell ICICI. That will be for intraday, purely for intraday. And I have given Syndicate, IndusInd and Dena Bank now. So I need to see what that analysis says. So I have this live streaming data. So let me close it for a couple of seconds. So this is the theoretical aspects of this thing. We are taking Jensen's alpha. So this is the formula for the Jensen's alpha. Interest rate is a part, beta is being implemented that. Sharpe ratio, this is interest rate is a part and annual volatility is a part in this formula. Turner ratio and beta of a stock, interest rate and return of the stock produced. So these three parts are, just to see these three ratios internal. First ratio take interest rate and beta, but two stocks are being compared. Two stocks return is being compared. Second gives here that individual stock with its interest rate and volatility. Turner ratio, individual stock, return in a particular period, monthly return, yearly return, what is the average return they have produced, or 7 days return or 10 days return. So return on the stock, interest rate and beta of that stock as compared to the other one. So this is what these three ratios are saying. Then we will go back to the alpha and beta. So beta says that how sensitive one is with respect to other. Suppose if you are taking X and Y, two stocks, and beta is 1.2. So 1.2, that means each 1% change in X will bring 1.2% change in Y. That is based on their sensitivity. Sometime what will happen, this will go up by 1%, but Y will not obey that relation. Y will move only by 0.5. So this deviation from their beta principle creates the beta decoupling, and that decouplingness we are going to mark it on. So this decouplingness of X and Y, whatever we are getting here, this decouplingness is going to create the opportunity for the trade. And why this? And this decouplingness, once it comes, one costlier stock can become more costlier and one cheaper stock can become more cheaper. And while devising this X and Y, the stock which is having higher volatility must be X, stock which will be having lower volatility will be Y. Whenever one index and one stock is taken, one index and stock is being taken, that time the stock will be always Y and index will be XY. The index is consisting of multiple stocks, henceforth index will be given more weightage, more rewards for that. So this data is not loading, so we'll be just again refreshing that thing and we'll see that data is loading or not. So fine. So let me see. Let me close it and open it again. And so this is what the beta relationship you understood. Suppose if I'm taking say IndusInd Bank, and then I will take Dena Bank, and then I will be taking the Syndicate Bank. 25th July. So let us see whether the data is properly loading or not. I have to check my connectivity. So I think there are some issues with my connectivity. So I'll check it. Don't worry about that. So let us move something on this part. So what we have done here, we have understood beta. We have understood all these ratios, whatever they are doing. So how we will take a call in this? The stock which is having the higher Jensen's alpha, higher Sharpe ratio and higher Turner ratio is costly. It's costly stock as compared to the other stock Y. When X and Y are two stocks, after calculating these facts, the stock which is having higher Jensen's alpha, higher Sharpe ratio and higher Turner ratio is more costlier as compared to the other stock. And now then we will come to this beta decoupling point. So this every day some decoupling will be get created. Beta relationship will not be over. Whenever this decoupling moves above -2, or this accumulation of decouplings becomes above -2, sorry, below -2 or above +2. So that time we will say that some amount of trade opportunity is being created. Trade opportunity is being created. In case of a positive decoupling, remember this one. In case of a positive decoupling, if there is a X and Y are two things. In case of a positive decoupling, many of you are my seminarians. Can anyone will tell me if the decoupling is positive, which one to be bought and which one to be sold? Many of you have joined my paid programs. So can anyone will tell me if in case of a positive decoupling, which one should be bought and which one should be sold? I got only one answer. Wherein the independent means X should be bought, X is independent, Y should be sold if the decoupling is positive and that too above +2. Better you can say above +3 also, it is better case. Somewhat be more in the safest side. Somewhat be more in the safer side. So you can think of somewhat in that. So we have just loaded Infosys and TCS data. It is telling that it is without option hedging, means Infosys TCS we are going for there. See here we are just 0.7438 correlation, below 0.75, but below 0.75 we will be so pricing part I will be just telling with the option hedging also you can do it. So that is, I'll just move into that part. So let us see what price they are quoting now. So let us see what price these two companies are quoting, means these companies are quoting now. So what price points these companies are quoting now? Does anyone will give me the pricing if they have? I'll tell how to hedge with the option also. Have patience. Just we got the. It is telling that without hedging we can initiate this trade, and we'll just need to what price these companies are trading. So Infosys and TCS. So let me take one Excel sheet also, where we'll just do a small work. So 2459 and 1535. 2459, we are buying it. 1535, we are selling this. 1535, we are selling this thing. So many of you are, so one lot I have taken for future. This should be done with the future, not with the cash. Cash segment selling order you cannot able to hold. So lot size basis, the values you have to see. 125 is the lot size here, 3 lakhs. 250 is the lot size here. 250 is the lot size here, 3 lakhs 83. So you can say the value terms you have this much of sell value and this much of buy value. So out of 6 lakhs, out of total trade value of 6 lakhs 91,000, you have unhedged capital of 76,000. 76,000 of unhedged capital you have. So you can say 7 lakhs worth of contract you have entered into, but 76 means hardly some 8 to 9% of your capital is unhedged, and remaining is properly hedged with the buy and sell. So now someone has asked me if I am going to do this trade with respect to a hedging. Just if you are using this tool gives you enough information. We have already entered the trade. First we enter the trade. Bought Infosys, sell TCS. We have done it. Now we will go back to this part. Volatility, uptrend and downtrend price points. This is being given to you only for hedging purpose. TCS is having a higher volatility, 35%. So definitely it will be the dominating partner and X. Infosys is having 29%. This must be Y. So we have sold the TCS, and TCS is having a uptrend above 1577. So I'll just figure here 1577 above. This is entering to a 1577 above. This is entering to a uptrend. So this, whenever I analyzed, and this uptrend I have given you, this is given with the estimation that you will be holding this position for maximum 10 days period, not beyond that. Maximum 10 days period you will be holding. And Infosys, which I have sold, its downtrend starts at 2395 level. Its downtrend starts at 2395 level. 95 level. So if I am a conservative trader, I can think of buying a put option of Infosys around 2400 strike. See the way I have just, and I can think of buying a call option strike around this 1577. So nearest will be, so let us see option TCS. If I am just buying some options, I am just a conservative trader. I will give you other way also. So do not worry about that. TCS, so I will be just going for 1477, 1460 also I have, 1480 also I have. So 1480 call option. Sorry, 1580. 1577 I think. 1577. So I will be going. Infi is bought and TCS is being sold. So Infosys is bought 2459 and TCS is being sold at 1537. So this is what Infosys and TCS and Infosys, buying Infosys and TCS, all four parameter is telling you, and without option hedging because the correlation is below 0.75. So this is the thing we have done here, and we have bought it and we have sold it, each one lot. 76,000 capital is unhedged. We bought this thing. Henceforth, to protect this future, we are buying a put option at 2395. So 2400 will be the nearest strike. So here 1580. So TCS 1580 call option, not this one. 1580 call option at the price of 40 rupees say. So 1580 call option. Somewhat we will optimize this also. Call option at 40 rupees. And 2400 Infosys, Infi, which is currently at 2457. So we will be going for 2400 put option, which is so July. Extreme time values are there. So Infosys, if I am not wrong, it is 2457 now, and 114 rupees is the put option. 114 rupees, 114. So suppose if you are buying a put option, 114, here 40, a huge time value you are paying to the market. Huge time value you are paying to the market. There will be a huge time value you are paying to the market, and by this process, suppose you have protected. Second option, I don't want to pay this much of time value. I just had to pay the time value. Just had to pay the time value. So how I can minimize it? So just go back to your pair trade analysis once again. Infosys you have bought and its uptrend is saying that 2514. Currently we are at 2458 level. So 2458 level, 2458 level, and uptrend is at 2514 level. Uptrend is, so 40 rupees, 40 to 50, 60 rupees we are still having. So if I do in this order, I can get back some of the time value from the market. 2514, 2500 call option, let me see. Call option, let me see. What price 2500 call option is quoting? 123 level. So 2514 level, fine. So I can think of in this order also 2550 call option. I can think of my uptrend is, so this is for downtrend, uptrend is 2514, 2514. Henceforth I am selling 2550 call option. I am not compromising with my profit. I am just selling 103 rupees at 103. I have paid 114 rupees as the premium here. So without compromising with my profit, which is going to come if the this goes to 2514 at 103. Same way, downtrend of the TCS downtrend is 1486. So nearest strike I have to see. So TCS downtrend is 1486. Nearest strike is 1486 nearest. 1486 nearest. 1480 put option. So 1480 put option. TCS downtrend is at 1486. 1480 is put option, 35 rupees. I can still go for somewhat 20 rupees down also. So 1460 put option, let me see, 30 rupees. 1460 at 30 rupees. So my 1486, my downtrend, I sold at this thing. If it is falling down, I will be at a profit. So this is my downtrend for the TCS. So I am selling 1460 put option at 30. See the best management I have done to take out the money what I have paid in terms of time value to the market. So my net trades will be buy Infosys, buy Infi at 2459, sell 2550 call option, which is above my uptrend price 2514 at 103, and same time I will be buying the 2400 put option at 114. 114. I have not sacrificed any of my profit here. I have just hedged my position, pair trade position. Whatever money I have paid to the market in terms of time value, equivalent money I am just taking out from the market. So same way I will sell TCS. Think of initiating this trade 1535 and sell 1460 put option at 30 and buy 1580 call option at 40. So by this process I converted my positions to a covered call with put and covered put with call option strategy, still having the view on the pair trade, without sacrificing my profitability in the pair trade. I have just done this thing, and by this process also I did a excellent risk management. So if you just net off all these option prices and calculate, I hope it will be, you can say 30 we are selling 95. So 95 means 15. I can less it from here. So 25 points I can lose. Maximum 25 point I can lose in the TCS. 250 is the lot size. And same way, if I am just going to do for the Infosys I sold 1550 at 103. So this is reducing my 359, 356 to 2400 minus 2356. So this is 44 rupees premium. So then 114 minus 44. I am not going to hold it till expiry. So this is also, by this process, my liability in worst case. In worst case, if Infosys I bought, it is going on falling. TCS I have sold, it is going on rising. In worst case, my losses will be 15,000, and losses will be 15,000. In worst case, if the Infosys is going on falling and TCS is going on rising, then for this consecutive for this 10 days and goes to any infinity level also, then also I'll have a worst losses of 15,000. If I win, how much I will win here? So 640, 40 rupees here. So for 40, 50, 90, and you can say 90 and 11 rupees I can say. So 90 minus 11 if I will make it. So 79 points. So if I am winning, so if the pair trade principle goes correct with me and the stock what I have bought is rising and the stock which I have sold is falling, then I will have 43, 75 minus 10, so 65. So 65 will be the net of here. And 10 days period, if the if the pair trade goes with me, and it is 250 size, lot size, so this is 125 lot size. If this trade successes, then I can get 26,125. 26,125 maximum gain. I can incur maximum losses of 15,000. So this is the risk and the reward, and I can hold it for maximum 10 days. I have given this projection based on all the time value in the option becoming 0. With that perception I have given this projection. This projection I have given with the view that yes, this projection is going, you are going to hold till expiry, and Infosys you have bought, it is going on falling. TCS you have sold, it is going on rising. In this worst scenario, your losses will be 15,000. If our pair trade analysis comes true and the costliest stock which is TCS currently is falling and the cheapest stock which is currently Infosys is rising, and then we can have this strategy can give us 26,000 gain, which is near about 1 to 1.5 or 1:2 profit, maximum gain and maximum losses. Any further questions in this regard? If anybody is for Infosys is setting at 2514, I sold 2550 call option, that is to also 100 plus from the higher premium. So I received whatever the money I have invested for Infosys put option, which is 114. Out of this 103 I have received from this call option. So my aim is that I will not pay much time value to the market. I kept it in the neutral stage. And same way, 1486 is my downtrend starts for TCS. I am selling 1460. Some 26 rupees below, that too also put option I am selling it at a rate of 30. So by this process, I have managed the time value decay components, and whatever the money I have paid, I have just taken back from the market. Assuming if both the trades are against me, means TCS is rising and Infosys is falling for consecutive 10 days. I repeat, I am holding for 10 days, maximum 10 days. For consecutive 10 days, if TCS is going on rising and Infosys is going on falling, in worst case, my losses will be 15,000. If my analysis favors me and it goes as per my anticipation, Infosys increases and TCS decreases simultaneously, then my profitability will be sitting at maximum 26,000. These two projections I have done considering all time value in all these options should cease to 0. So which is not true also. So your projections of losses will be definitely lesser, projections of profit also you can definitely lesser. So 50 to 60%, because you are not going to hold it till the expiry date. So any question?